back, everyone. Recently, we had a new GDP report, came back positive, or did it, right? It was an increase of 2.6%, taking us out of the technical recession. There's a lot of factors that play into calculating the GDP, and some have more effect than others, and some are more crucial in the current moment than others. So we're going to have to really dive into the logistics, into the fine print of this report here, and join along with me right now. So yes, we saw some marginal improvement, but not in the places that count. Consumer spending posted the second lowest reading of the pandemic recovery, and interest rate sensitive sectors got hit hard. These were seen as expected, but it is not a reason to back up tightening just yet. Right, so as we see here, GDP rose 2.6%, better than consensus. But what does that mean exactly? So we see domestic purchasers, inventory trade just rose 0.5%, and private domestic purchasers just rose 0.1%. So these are really big things to look at to kind of gauge the overall economic well-being, right? This has a large factor in consumer spending and how people view the outlook over the next 6 to 12 months, right? Economists do say it's a very, very important thing to look at when determining consumers and how they will react. And we can see that these numbers coming in lower than expected has a direct impact with consumer spending decelerating at a 1.4% annualized pace. Now, what does this mean, right? We have seen these numbers happen before, where GDP rises while domestic purchasers don't, right? So that doesn't mean that we are nearing the bottom or that we are anywhere near a good place, essentially. Right? These two circles, these two places that I just circled, look very similar, right? We have real GDP increasing while these two larger factors are decreasing, right? So we saw this increase in GDP in late 2021, but that didn't mean anything for our economy in the next 6 to 12 months. And we're kind of seeing it again here, but if history repeats itself, if the stats don't lie, then we probably won't see necessarily the economy do well in the next 6 to 12 months. So these two are very important to look at when determining what the GDP values really mean. And once again, we see another crucial one right here. Non-farm productivity likely improved in the third quarter, 0.4%. That said, output per hour has downshifted from both pre-pandemic paces. So this is unfortunate because if this trend persists, it will add pressure to the Fed to hike rates higher, right? Which is not good. But for some good news here, we see PCE prices coming in lower than consensus at just 0.3 and 0.4%. So that's pretty good. We are seeing this goods inflation start to downturn, something the Fed has been focusing on for a very long time now. And so as this goods inflation starts to downturn, we really cannot have services inflation start to increase, as we're kind of seeing here with the non-farm productivity of services, with a wage price spiral on services. So we have to be very cautious of these numbers, because as we see goods numbers, inflation start to go down, and if services start to go up, we could be in for a whole new wave of inflation that we haven't even thought about in the past year. And here we see another example of these numbers coming in more misleading than we might expect, right? Total non-residential investment rose 3.7%. But where did those numbers come from? We saw equipment and spending jump 10.8%, largely due to inflation. So that's a bad sign that's rising. Now, intellectual property products posted a 6.9% advance versus 8.9% prior. So that's going down. And structures investments dropped by the most since spring 2020 lockdowns at negative 15%. So September data pointed to less momentum in core durable goods orders a negative sign for the outlook, right? Core durable goods are goods like automobiles, trains, infrastructure, things that aren't supposed to erode until 3-5 years down the line. And this is a very crucial thing that economists look at as a sign of the next 1 to 3 years. And so when these are down, when structures investments are down, but equipment spending is up due to inflation, we're kind of having these numbers come out and lie to us, right? So although it says non-residential investment rose 3.7%, it is actually not as good as you would have expected. Now, federal, state, and local government spending rose 2.4% annualized. Great headline, right? Well, let's see why. Defense spending led the charge at 4.7%, war-related, right? So although we see this 2% increase in spending, it's because of war, and it's also because of strategic petroleum reserve, right? So war and oil, which is related to war, is the only reason, or the main reasons, that we saw an increase in government spending. So we see these numbers, and they come out positive, right? Takes us out of the technical recession, but the reason that they are increasing is actually not good. It's actually worse than if we're not increasing. So that kind of puts us at a 6 to 12 month outlook that is worse than the place we are at now. And here again, we see a very crucial thing for GDP, a very crucial factor, the trade deficit, right? The trade deficit narrowed sharply, which means we are exporting more goods than we are importing, which sounds good, which is actually one of the most crucial things for an economy, essentially. But the reason for it, once again, is poor, right? Falling imports is not a positive sign, okay? It means that there is less business being done internationally with the US, okay? Less liquidation, right? Other countries, other international companies see better opportunities outside of the US, so they don't need to do business with the US. And that kind of brings us to this point. And economists expect a slowdown from 2.4% to a meager 0.5%, with emerging markets slowing from 4.1 to 2.7 Fahrenheit base, right? So we had these good numbers, but now it looks like things are starting to buckle down. We have this 6 to 12 month lag with a lot of these indicators. And so yeah, 6 to 12 months ago, the economy may have been doing well, or it was doing well, but now we are set to see a decline, right? We are set to see a 0.5% increase. And so you really have to kind of go into this next year with that knowledge that we might not see the best news. And yeah, so yeah, thank you for watching, and tune in next time.